Okay, good morning, ladies and gentlemen, and welcome to MACROACE with your host, Tony. I'm also the head financial analyst at FinancialJuice. I wasn't able to do a live stream yesterday due to some circumstances, but today with Nonfarm Payrolls, let's get right into it and not waste any more time. Now, so first of all, we have to define what it is. It represents the net amount of jobs created in the prior month. And you also have the household survey, which represents the unemployment rate figure. So the establishment survey is where the headline figure for non-farm is derived from, and that measures or that represents about 666,000 corporate and government work sites reporting on their jobs and the amount of jobs that they have at the moment. Then how does it affect the markets? So you have with the currency, a stronger than expected jobs report will lead to a stronger dollar in anticipation of a central bank that may continue with their tightening phase or keep rates at where they are. Or on the flip side, if the economy is doing well and there isn't a hiking or tightening phase if there isn't a hiking or cutting phase that's going on within the economy, stronger than expected jobs reports will then show that the economy is healthy and that there is a good pickup in the amount of jobs that are being created. On the flip side, though, for the stock market in this environment where the central bank is kind of umming and ahhing about when they should cut rates this year, if it would be in March or May as a first rate cut, if you do get a stronger jobs report much stronger jobs report than expected, that could lead to markets repricing their expectations for potential rate cuts this year, and could lead to some bearish movements to the US indexes instead for the US stock indexes. For the bond market, bond yields will tend to see a healthy pickup or a bullish reaction if the jobs data is much stronger than expected, with the bond prices then heading lower. Again, same reason for the currency, in anticipation that the Fed might push out the potential for an interest rate cuts for later on in the year, or if the economy is doing well, again, yields tend to go higher to try and attract those investors who would have moved their money to more riskier assets that are more profitable from government bonds that are not seen as so appetizing or and are not as risky as equities. Then the indicators weighing in on sentiment. We have inflation, that was at 3.4%, which ticked up from 3.1%. PC price index was at 2.6% compared to 2.9%. William Rogue says, what about gold? I love gold. Okay, so the same thing would happen to gold as it would to stocks. As long as the dollar's appreciating, if the dollar is strong, then gold is expected to be weak. So there's that correlation that we have to be aware of within the markets. So hopefully that answers your question there. GDP fourth quarter was at 3.3% compared to Q3 of 4.9% compared to the final read. ISM manufacturing employment is at 47.1, ticking down from 48.1. Manufacturing PMI was at 49.1 compared to 47.4. Services employment was at 43.3 compared to 50.7. And services PMI is at 50.6 compared to 52.7. JOLTS job openings was at 9.026 million compared to the prior of 8.925 million. Employment costs ticked down to 0.9% compared to the prior of 1.1%. And ADP employment change was at 107k compared to 158k. And then finally, with average earnings year on year, ticked up to 4.1% compared to the prior of 4%. So these are the key bits of data that we have to be aware of that could have an impact on the non-farm payrolls figure itself. Particularly if we're looking at the employment side in the services and the manufacturing side. So you can see that there is a substantial tick down or decline in those areas, particularly in the services side, where a lot of the issues have come from for inflation remaining quite sticky. A lot of that has been attributed to wages in the services sector, not only in the US but also in Europe as well, of businesses keeping their wages high to keep their employees on their workforce. So that's one thing to be aware of, is that with a tick down in the employment for the ISM services and manufacturing, that could also show a good indication that economists forecast for inflation to add about 185,000 jobs compared to 216,000 jobs, could be showing that nice decline. And also for the Federal Reserve too, if we do get a much weaker than expected report, let's say, from non-farm payrolls, that will then bolster the bets for Fed rate cuts and might put the idea or the bets for March back into play, depending on how weak the data is. Now, realistically, it could be that even though Powell did say that March is out of the question more or less, it may jolt the Fed's point of view of where they see the economy. And it may mean that, as I said, a stronger pricing in could happen for May if that occurs. But if you do get data that is more or less in line with expectation, then May would be could be the first date that the Fed does decide to cut rates, rather than maybe later, because things are kind of trudging along nice and easily. But if you do get stronger than expected data, that could lead to pushing out a rate cut further into the year, maybe into June, or at the very worst, a push back into July would need the figure to see. This will be temporarily, probably, with markets, with speculation, but it could, if you do get a really big deviation towards the upside, if we're looking in at least the 200, if we're looking at least 200k deviation, maybe that could then spook the markets and lead to a bearish reaction within the stock market and lead to a bullish reaction on the dollar, potentially. Okay, so let's continue into it. So with the triggers then for non-farm payrolls, economists, they're looking at a high estimate of 300k and a total deviation of about 115k, with a low estimate of 120k and a deviation of 65k. The unemployment rate is expected with a high estimate of 3.9% compared to with a low estimate of 3.6%. Average hourly earnings with a high estimate of 4.2% and a low estimate of 4%. And then private payrolls with a high estimate of 282k and a low estimate of 91k. So the reason why I still keep the average hourly earnings in there is because wage inflation is still important to the Fed's goal of trying to bring inflation down. If you do get a stronger than expected figure for average hourly earnings and the rest of the report is in line with expectation, that could mean that the markets then focus on the inflation, wage inflation data, whether it be positive or negative, and then make the decision as to which way the market could go. So if you do get a higher than expected average hourly earnings data, that could tip the market into seeing a bearish move if the other data points are more or less in line with expectation, and vice versa if it were to be lower than expected. But of course, the key focus is the headline figure itself before anything else kind of comes through. And then you're looking at these other areas to see what the picture of the labor market is like at the moment within the US for the prime month. Does that make sense? So I'm saying look at all the data points all together: inflation, wage inflation, still an important part of the Fed's goal to try and bring inflation down. If it's stronger than expected, could get a bearish reaction from the market potentially if everything is as expected. A weaker than expected average hourly, a lower than expected average hourly earnings report could lead to a bullish reaction for the stock market if everything else is in line with expectation potentially. Yeah, I'm going to presume you guys understand. Why do UFX says great view? Okay, I presume you guys took that into consideration. Let me know if you do want me to repeat anything. I'll go over it. Of course, it is much simpler than the Fed interest rate decision because you're just looking at a bunch of figures and that's it. So the previous report for representing December on January 5th. So the employment continued to trend up in government, healthcare, social assistance and construction, while transportation, warehousing lost jobs. So specifically, you had 52,000 jobs added in government, healthcare, about 38,000 jobs added, social assistance, about 21k, construction, about 17k, and transportation, warehousing lost about 23k, leisure hospitality added about 40k, and retail trade added about 17k. Then Fed and government views. So Fed's daily on January 19th said that any early signs that labour market could falter could also trigger policy adjustment. Yellen on the 25th of Jan said that pressures in the US labour market are easing somewhat. From the Fed Beige Book on January 17th, it mentioned that nearly all Fed districts reported cooling labour markets. And then January 16th, Fed's Waller said that ongoing moderation in labour market supports progress towards 2% inflation. Then the investment bank views. So let's start off with Goldman Sachs. They say that a softer jobs report could easily make the case for insurance cuts clearer, i.e. that if the economy is faltering, then the Fed might take some maybe quicker to cut rates as an insurance to potentially stop the economy from faltering and going into a recession or going into a downward trend spiral. Bank of America say that job growth should again be narrowly driven by the public high-touch service sectors. Meanwhile, the unemployment rate is likely to remain at 3.7%. Credit Agricole say that with a preliminary forecast for 170k for NFP and 3.8% for the unemployment rate, they expect this to remain consistent with a labour market that has clearly begun to cool but remains tight overall. So they think that data in line with expectations would keep the Fed on track to cut in the not too distant future, but not imminently. They continue to expect that the market pricing has gone too far in showing more than a 40% chance. This is at the end of last week, by the way, these comments were made. They say that they continue to expect that market pricing has gone too far in showing more than a 40% chance of a cut in March and more than 130 basis points of cuts this year, even after the recent repricing. Morgan Stanley also weighed in, saying that lower jobless claims and unusually warm weather in January suggests a solid payrolls print. And then MUFG said their case for March cut would be reinforced if releases next week of the latest non-farm payrolls report for January unemployment cost index for Q4 are weak. So that should kind of clarify the views then of what the investment banks feel about the non-farm payrolls report. So more or less, if we're looking at how if we're looking at MUFG, if you do get a weaker than expected report, then that could lead to the Fed maybe going ahead with a March rate cut. Potentially, although we'll get more data before the next meeting. That all depends on today's data and also CPI when we do get that this month later on. But overall, if we let's say if we do get a much stronger than expected figure, when most economists are looking for the labor market to cool, then it means then that could then provide a bit of volatility. Maybe not a lot if the deviation isn't that great from what markets or from what economists are expecting. But it could be enough to maybe do a little bit of repricing for the upcoming rate decision from the Federal Reserve. But probably wouldn't be enough for the markets to expect a March rate cut, considering what Powell had said on Wednesday. So let's have a look at the last bit of data that we'd seen back in January. So what I'm going to do is I'm going to so this is about 10 seconds before that release had occurred, back on the last report, and when the data had come out, so non-farm came in at 216k, which was above the forecast, which led to the dollar seeing some strength from that data, and weakness from the US stock indexes off the back of that data. And if I kind of skip forward a little bit, you can see that I had a position on there too, which I shorted, kind of left it open, and then closed it soon after. If we keep going forward, let's see. Let's go about 10 minutes, shall we? It's probably about over there. Oh. Okay. So not exactly 10 minutes later, but you can see that the market reaction did keep itself down for a while, if we're talking about the initial market reaction, rather than popping straight back up. So if we look at the deviations and the reason why, as to the reason why that happened, and look at the other figures as well, you can see here average earnings, although it did tick up by 0.2% compared to the forecast, private payrolls was also stronger than expected as well. So the deviation wasn't fully met on non-farm payrolls or the figure itself. So other data points, average earnings, the private payrolls was stronger than expected. The unemployment rate also remained unchanged at 3.7% when economists were expecting it to tick up to 3.8%. So we need to look at all the data together, and then to try and quickly make our decision as to whether that's enough for us. All right, so let's get out of this here and have a look at the deviations and have a look at where the biggest market reactions had occurred last time round. White Eagle FX says, what's your view today, bullish or beat? Well, I don't do that because that's a bit too speculative. So I'd rather just wait for the day to see what happens. Okay, so let's have a look at the past bits of data. If we go from, where are we? There we are. So we have a look at the ranges and deviation ranges Google Sheet at the last release. Okay, so the deviation wasn't met on non-farm payrolls. Okay, you had about a 41k deviation. We were looking for about a 60k deviation last time round, if I remember correctly. Everything else was stronger than expected, which would have led to the downward pressure on the US stock indexes, or continuing to be held around where it had initially made its first candle, rather than doing what it did last time when the deviations weren't met, but the overall report wasn't that strong either way, and it didn't lead, and that time around it led to a reversal in about 10 minutes of trading, okay, or 10 minutes of the report being released. So let me make this make sense for you guys so you understand what you're looking at. If this is the first time you're seeing deviations and ranges sheet. So this shows you how much the markets have reacted to the past economic releases and how big were the deviations. Okay. Now these figures here, hopefully you can see what I'm highlighting. The first figure that I've highlighted here shows you the initial market reaction going to the wick of the candle. Okay, because I always like to capture the entire move. Then the figure in the brackets shows you the move 10 minutes after the release has occurred, going to the end of the candle. The figure in the blue brackets represents the move 30 minutes after the release has come out. Again, going to the end of the candle. So you can see here, although the deviation wasn't met, you did still see a decent initial move towards the downside, but then it also started reversing after it was already reversing before the first 10 minutes were up, but not by a lot. Then after about 30 minutes, then it had a clawback where it had paired where it reversed its losses on the S&P 500, and then moved towards the upside, and it was 8 ticks up after about 30 minutes of trading. So that's one thing to be aware of, is that when the deviations are not met, that it could still be an opportunity, but to be aware of how long that market reaction lasts. Hence, having a look at the deviations and ranges Google Sheet that I provide to you guys here, which is completely free if you sign up to the MACROACE mailing list, gives you that opportunity to be able to look at the data and then come up with your own decision as to what should be done. Okay, of course, it's not indicative of me saying that this is definitely going to happen in the next non-farm payrolls report. It's solely there for you. So look at the data. It's how the market's reacted. You do what you want with it. Okay, and as I said, it's completely free. All you've got to do is sign up to the MACROACE main list, and then you'll get an email every Monday with the upcoming economic releases, a small summary of what to expect in the Europe, US, and Asia session. And I said, if you're a new subscriber to the MACROACE mailing list, then you will get the link there Monday morning. Okay, so if you subscribe today, you won't get it today. You'll get it tomorrow instead. Sorry, not tomorrow, Monday instead. All right, so if we're looking at the currency pairs then in that space, if we look at the biggest market reaction that we've seen has consistently been in the dollar yen. Okay, so here we had 79 pips towards the upside on the initial market reaction. And then after about 10 minutes of trading, it was still up, but it did reverse some of its gains to be 64 pips up after about 10 minutes. And after about 30 minutes, and then it was still up, but now up by 26.2 pips after 30 minutes of trading. So the currency pair, the dollar yen, has seen the strongest reaction in the past compared to all the other currency pairs that are listed here. If we're looking at the bond spaces too, and the bonds, usually it's always the shortest rate that has the biggest market reaction, because that's the one that is the most affected by the central bank's interest rates, and is also very sensitive to what's going on within the economy as well. So here we can see the 2-year bond price, bond futures for ZT had seen about 39 ticks down initially, and then started reversing its initial gain, but was still up by 15 ticks after about 30 minutes of the release coming out. Okay, so here's the scenario then. If we do get our deviation for non-farm payrolls, and we also get the other bits of data that also meet their deviations, then you could see a strong reaction, i.e. a reaction that is sustained, rather than a quick flash in the pan and then the markets start to reverse on themselves, okay, and then go in the other direction. That's the risk that you have if you don't get a big enough deviation for non-farm payrolls, if that isn't met. Hence, the bigger the deviation, the more opportunity then that there is presented, and then that means that your trades could actually have a bit more of breathing room rather than being kicked out too early. If the data is more or less in line with expectation. If the data is more or less in line with expectation and there isn't too much of a deviation, then you're kind of looking at the other points of data other than non-farm itself. You're looking at private payrolls, the average hourly earnings, the unemployment rate, to see if data is better than expected or not. And even then, if all the data is in line with expectation, then there could potentially then be a whipsaw reaction, i.e. the flash in the pan reaction, and then it might not be a good idea to jump in, potentially. But I always say this: do whatever you want to do, whatever makes you feel comfortable. If you've had a look at the data and you've had a review, make your decision. Don't let me tell you exactly how to trade it or what, if that's, of course, just providing advice, just letting you know of what could happen based on what's happened in the past with non-farm payrolls data. Okay, so we've got about 3 minutes left to the economic release. Let's get out of this here. So we're looking at the dollar yen, S&P, and 2-year bond price, or 2-year bonds. So let's get TICKSTRIKE up and running. See what we get. Okay, that's there. So again, if we look at the a reminder for the ranges and deviations, if you don't have access to the Google sheet, so the high estimate for non-farm is 300k, and a low estimate of 120k. Okay, with the unemployment rate, high estimate of 3.9% and a low estimate of 3.6%. Average hourly earnings with a high estimate of 4.2% and a low estimate of 4%. Okay, so just to clarify then, for non-farm, economists are on the high end looking for 100 and 115k deviation, and on the low end a 65k deviation. Okay, just to make you aware of what economists are expecting for the high and low estimates. So we got less than a minute to go now to the data. Let's see how this plays out. Yeah, headline NFP and average hourly earnings is key, but also don't forget non-farm payrolls too. The private payrolls data too, because then that could also add to volatility if the other bits of data are more or less in line with expectation. Okay, so I'm going to go quiet. And now, I'm going to go quiet now. I'll jump on in a little bit. Okay, so that was a good short trade there. The initial reaction. Okay, so let's see what so much higher than expected. As that's 353k compared to the forecast of 185k. Unemployment rate also stayed unchanged. Okay, so that's what I got at the moment there. This is the second position, by the way, just to let you know that I've got on. I think we'll close it out. Done. Okay, so there's two positions that I had. First short was around, let me see. Let's see if we can get up. Oops. There we are. So the first position, it jumped in around here. That was the first position. Okay. And then had come out at around, whoops. And then come out at around there. And then there was a shorter position that I took, which went to, of course, down to there, from going from around there-ish. Okay, so two good positions. That was good data. When I say good data, that was a much bigger deviation than what the economists were expecting. And of course, remember the highest estimate was 300k for non-farm payrolls, and you went 353k for non-farm payrolls. So we'll see how long the market reaction sustains itself. If we have a look at some of the other areas too, with the unemployment rate, didn't go to the low estimate, still remaining unchanged as it is. Average hourly earnings, let's see where you are. Average hourly earnings also ticked up. So the highest estimate was 4.2%. This is 4.5%. Okay, so I'm done with my trading for now. I've done my two positions. That's it. We'll leave it as it is. Okay, but yeah. So average hourly earnings ticked up 4.5. Didn't really help not helping the those guys who are looking for, or still trying to look for, a rate cut in March. So that should be blown out of the water now for a rate cut for March. Okay. So yes, don't forget, if you like the video, subscribe to the channel, get the word out there. Also, don't forget to share it with your fellow friends and traders if you found this information useful. What else we got here? Upward revision on, yes, on non-farm payrolls. You said upward revisions of plus 126k. So what else do we get here? Yeah, so prior revised to 333k for non-farm payrolls. So that's that's still a substantial revision on the non-farm payrolls report. Okay. All right. So, ladies and gentlemen, we're looking at non-farm payrolls there with us live. So, what I want to talk about is FinancialJuice. Let me just. I think I just heard James on the mic say that markets are looking for a May. Oh no, Fed swaps no longer fully price in a May rate cut. Okay, so March is pushed out. May pushed out. So that's okay. So the worst case scenario happened for the stock market in that case. But yeah, as I was saying, with FinancialJuice, if you've never come across a live voice and text service, or you never come across us, then FinancialJuice is a live voice and text service that provides up-to-date news of what's going on within the markets, the sentiment, if there has been any changes in sentiment, if there's been any thing that's occurred in the Middle East, geopolitical news in general, if there's a Fed speaker that says something that's kind of shocked the markets, then you can get all that news all in one place with us at FinancialJuice live in the pro version. So here, just to kind of go through what the site is showing you here. So here you have with the Pro version, you have this is where the live voice is played through, okay, where you can hopefully see my slider running. And in the center here, we have the text headlines, okay, of the up-to-date headlines of what's occurred. Of course, we have the market reactions from the economic releases as well. And on top of that, on the left-hand side, you have the economic calendar as well. That's also live in a real time of what to expect for not only the day ahead, but also the week ahead as well. Darius Tan says, thanks, made 3.5K today. Well done. That's pretty good. Good job. So as I was saying, left-hand side, you have your economic calendar, what to expect for the day ahead and also the week ahead. So then you're always informed of what to expect for your calendar. Now, you can sign up to FinancialJuice using the link here. Okay. All right, there you go. That is a link there to FinancialJuice. Now, what that will do is that will take you to the light version of FinancialJuice. So the light version of FinancialJuice, it does have a delay. It does have adverts that are played as well. But if you wanted to set up your Pro account, you first need to set up an account anyways on FinancialJuice, which will be on the live version. Once you've set up your account, you've got your login deets and you've verified your account from your email, then go back, select your subscription, and then once you've paid for your subscription, then log out and log back in, and then you should see the Pro version of FinancialJuice as you see it here as well. Bear with me 1 second, guys. I'm going to just have a double check of something. So, just wanted to confirm a couple of things. So, we do still have the New Year 92 promo code for FinancialJuice. So, getting 92% off a FinancialJuice subscription with the promo code New Year 92. So, if I put that in the link there too for you. Alex says, thanks, made $300+ today. Good job. Good. How useful did you guys find the information that I provided you? Was it good enough, or was it better than we expected? Was it not helpful? Because this will help me improve when I do these live streams with you guys. Because if you don't give me feedback, I'm going to presume everything is fine. So I always like to get feedback on things that haven't worked. James says, do you want me to send another email? Sure thing, buddy. Send another one. If there was anything new for me to work on, or you can just give feedback. If we can just give, if you want to give praise, then that's also fine too. Not a retail 212 mail. That's a good name. Saying it was great. John Bow says streams are not fine. They're great. Gosh, you give me a heart attack there. Not a retail 212. I like saying that. Well, I won't say it again. It's too long. You had a good entry as well. Do you normally enter on the 1 minute on news releases? For this, usually, yes. That's where the most amount of volatility that has occurred for me, and it's worked. Most of the time, I'll say, not all the time. Sometimes it doesn't work, but that just happens, So, but yeah, most of the times it's okay. Yeah. So as I was saying, so did I put it in there? I don't think I did. New Year 92 is, I did put it in there. Put it in there again. So New Year 92 is the promo code to get 92% off FinancialJuice, the pro version. Have a little look at it, and yeah, sign up. Now, if you're not ready to sign up, you can still use the live version of FinancialJuice, albeit with the adverts and the delay. If you're not used to financial news service, have a little play, get used to it, and then when you're ready, then go to the pro version. Just do it as just be comfortable with what you're doing, and whenever you're ready. Very 212 Mail said very nice. Got FJ Pro on an introductory sale a while back. It's been amazing so far. Just keep up the quality and we'll have way more customers in the coming months. James is great as well on the news desk. I will let him know too, and he's probably listening in, or he can probably hear me in the room over. Oh, great. Thank you for your review. So that is FinancialJuice Pro. Now, TICKSTRIKE is also here as well. Now, TICKSTRIKE, if you're not familiar with what it is, it shows you how strong the buying or selling momentum is within the different areas of different assets, stocks, FX, crypto, and in your ETFs and ETNs, your internals as well, like your VIX and ADD. Okay, that's what TICKSTRIKE does. It shows you how strong the buying and selling momentum is for those different assets, and is represented in what we call the ticker box here. Okay, so if I just bring up one here, so if we're looking at the dollar yen, this ticker box shows you how strong the buying or selling momentum is. The number represents the sensitivity of this ticker box. So 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling that occurs, TICKSTRIKE will give you a visual and audio alert. So again, TICKSTRIKE gives you a visual and audio alert as to how strong the buying or selling momentum is. Okay, so here you can see when there's a little bit of selling going on, then you have a minus figure, and then vice versa for buying momentum. 1 being the most sensitive to the reactions. If I drag this all the way up, and that's the beauty of it, I can drag the sensitivity to wherever I'm comfortable with. The higher you go, the less sensitive it becomes, to 15, which is the least sensitive. 15 being the least sensitive means only when there's a big amount of buying or selling momentum will TICKSTRIKE give you a visual or audio alert to what's going on. And of course, you can chop and change if you just want audio, or if you just want to have a look, if you want to see it visually. Okay. And then if you like scalping the markets for mini opportunities here and there during your day trading, then we have this lightning bolt button, which then becomes uber sensitive to market reactions. So every little bit of, well, I mean, you can see it on the screen there on the dollar yen compared to this ticker here. So this lightning bolt means it's uber sensitive to market reactions. So every little bit of buying or selling that is occurring is being relayed to you here on this ticker box. Okay, and the same thing, you can adjust the sensitivity of how crazy you want to go. It's too crazy for me, but of course, as I said, if you like scalping the markets, then definitely go for it and utilize it to the best way that you can, and see if it works for you. Now the key thing, if I said see if it works for you, if you've never come across TICKSTRIKE before, then first thing you want to do is have a look at the news feed that we have here. So on the right hand side, underneath the voice feed, Okay, we have TICKSTRIKE here, which is the free version, but it is restricted to only the S&P, Euro, Dollar, Oil, and Bitcoin. And the sensitivity is also fixed as well. So, as I said, if you've never come across TICKSTRIKE before, have a little play with that too. And then if it's something that could work for you, then go to the pro version of TICKSTRIKE, which is here. Okay. And that is the link there. Okay, so that's the link to the pro version of TICKSTRIKE. Have a little, if that's something that you want to do. But as said, you do have the free version on the FinancialJuice newsfeed to have a little play, wrap your head around it, see how it works. There are also on the link I've sent you different videos how to set up TICKSTRIKE and the different tools that are there as well. Okay, so that's TICKSTRIKE. Now, as said, if you want to get the access to the ranges and deviations Google Sheet, then then sign up to the MACROACE mailing list. Okay, so I'll put that in again. I think that's probably gone now in the chat. That's disappeared. There we go. So that's a link for the MACROACE mailing list. Now, with the mailing list, let me show you what the email would look like, okay, in its basic form. It is very basic. There's not a lot of detail in there. The reason why I deliberately do that, is because it's supposed to act as a refresher for what to expect for the week ahead, and some bits of news of what's happened in the past over the weekend or the past week. So here we go. So this is what it looks like here as an example of an email. Okay, so as you can see, not a lot of detail. Okay, and that's when there's not anything going on, when there's not anything being covered in the week. We'll let you know if we're going to cover any releases in the week. And next week we've got the Canadian employment change data. But here you can see a summary of what to expect in Asia, Europe, and the US, and some stuff of what's happened over the weekend and maybe the beginning of the week on the first, and then on the Monday as well. But remember, I send one email a week on a Monday before the US markets open, of what to expect for the week ahead. And then here you can see that there's a button that says ranges and deviations. The next email that I'm going to send should just be the name ranges and deviations with hyperlink, a link attached to it, a hyperlink. Okay, so should be nice and simple. But yeah, in a nutshell, that's basically what it is. And you also get the live streams for the upcoming economic releases, if there are any that we're going to be covering as well. Okay, does that kind of clarify everything for everyone there about MACROACE, FinancialJuice, TICKSTRIKE? Well, if it did, thank you very much for joining me live today. I hope you guys made money, made that moolah. If you did, great. If you didn't, it's unfortunate, but it's another learning curve then in that case, as it has been for me. All right, so like I said, not every trade has been perfect, but I try my best. That's the only thing you can do, is manage your position, don't go crazy, and just keep learning and practicing. Okay, see you guys next week for Canadian employment change. All right.